Good afternoon, and welcome to today's webinar focused on the sports investment ecosystem and our recently launched sports and live entertainment focused ETF. My name is Katie Durkin, and I'm a Senior Vice President at Gabelli, having joined the firm in 2015, and I will be the moderator for today's session. Today, I'm joined by Chris Marangi, our co-CIO of Value, and the portfolio manager for the Gabelli Opportunities in Live in Sports ETF, ticker GOLS. Chris joined the firm in 2003 as a research analyst covering companies in the cable, satellite, and entertainment sector. In 2006, he began managing mutual funds alongside Mario Gabelli and separate accounts in 2012. In 2015, Chris was named the co-CIO of Value and just last month launched the GOLS ETF. Welcome, Chris. It's great to be here with you.
Great to be here on such a sports heavy week between the Super Bowl and the Olympics.
Yes, exactly. Well, Chris, before we dive into it, and for those that may be joining us for the first time, I just want to provide a little background about Gabelli itself. Gabelli is a global investment manager founded in 1977 by Mario Gabelli. Today, we manage over 35 billion in client assets across our value, growth, fixed income, and convertible securities via an array of investment vehicles, open and closed-end funds, ETFs, and separate accounts. Our dedicated teams of research analysts and portfolio managers conduct fundamental bottoms-up research utilizing the Gabelli private market value with a catalyst investment approach. Chris, with that in mind, it would be great to learn a little bit more about your background covering these sports and entertainment companies.
Well, great. So as you mentioned, I joined the firm 23 years ago as a media and entertainment analyst. We've got decades of accumulated compounded knowledge about these sectors. We don't go quite back to the Gutenberg printing press, but back 50 years ago, it was really about newspapers, movies, and broadcast television. We're still covering all of those things, especially the latter two. But as anybody knows today, it's about streaming, it's about user-generated content, snackable content. One thing that hasn't changed, live and sports. Those are still important, still actually probably more important than they've ever been. And we've been investing behind this theme for many, many years. I think we've got critical mass to actually make this a separate product, and that's why we launched GOLS.
Great, Chris. Thank you so much. So with that in mind, what are the key components of this landscape that we should consider?
So, we're talking about several revenue streams, particularly the biggest is gate. It's actually buying tickets, usually on a subscription basis, showing up at a game, buying a beer, buying a sundae in those little helmets, and buying some merchandise. The high margin and probably most valuable revenue stream for most teams, however, is media. It's what the big broadcast and cable network and increasingly big tech companies are paying to air these things. And then you've got, of course, sponsorship, signage, and other licensing businesses, all important to what we're doing.
So looking ahead in 2026, what are some of the key trends or factors that we should be aware of?
So there has been a shift from buying things to buying experiences. And we've seen this in the data, not to throw too much data out there, but the Bureau of Economic Analysis, which tracks inflation data, actually counts spending on live and sports. And those two segments over the last 65 years have actually compounded at about 8% versus 6.5% for the rest of consumer spending. So the consumer's spending more of their marginal dollars on the things we're focused on. And I think there are a number of reasons for that. Some of it may be because of what's happened with technology, people with their heads in their devices. Some of it probably is because of COVID, but there's an increasing desire on the part of consumers to be together, to experience the same kind of things live.
So if you talk a little bit more about some of the revenue streams there then and the major trends.
So the biggest thing that we're watching and probably the most important is this transition of media revenue from the traditional broadcasters for whom this is really important to the big tech companies. And now you have all the big tech companies that we know as players in live, whether it's Apple buying the exclusive rights to Formula One here in the US, to YouTube, others buying various rights to some of the other big four sports leagues in the US. And that's going to increase. And those are big pots of money. And they're doing that because this is compelling content. If you look at where people spend their time, 7 of the top 10 programs in 2025 were sports. They were the NFL, and it probably would have been 10 of 10 if it weren't an election year. So this is anchor content for a lot of people, and that means pricing power and bigger revenue streams for most leagues and teams.
Okay. So in terms of the investable universe, then you have the franchises, you have the leagues. What else is there?
So yeah, so there, believe it or not, are about 30 publicly listed franchises, leagues, promoters. Many of those are overseas. Some, if you're not a soccer fan, you wouldn't have heard of, but it's a decent amount. But we're beyond that, investing in other members of the ecosystem. These are companies that own some of the venues, like Madison Square Garden Entertainment, that are ticketing companies like Ticketmaster, which is owned by Live Nation, as well as the media partners. Again, very important revenue streams for those companies.
Thank you. Shifting a little bit to the Gabelli private market value with a catalyst approach, maybe you could just share for our audience what exactly that is and how you implement it in this landscape.
Sure. So this is, I should emphasize, an actively managed ETF. We're not just coming up with a bunch of names and passively putting money in them. We are trying to use our private market value with a catalyst approach. This approach was articulated first by our founder, Mario Gabelli, in the late 1970s. And basically, private market value is what an informed buyer would pay to own the entirety of a business. That is in contrast to the public market value, which is every day listed on the exchange. The difference between those two things we call our margin of safety, and then we look for one or more events typically that will narrow that discount, and those we call catalysts. So that could be anything from industry consolidation to financial engineering like spinoffs to changes in management, changes in regulation. And we've got a lot of those present in this ecosystem, which is partly why it's so exciting. The other interesting thing here is there have been a lot of transactions, mostly private market transactions, and that's one of the ways that we estimate private market value. You look last year, you had some big trades. The Los Angeles Lakers basketball team sold for about $10 billion. That was a good comp for publicly traded companies like the New York Knicks, the New York Giants for over $10 billion. Total Wolf's Formula One team for $6 billion. And so we take those all as input into how we estimate private market values for a number of the publicly traded franchises.
Spinoffs has been a recurring theme. Maybe you can share a few examples of some of the companies that we own and how we've owned them historically.
Yeah, so one of the areas that I focused on has been financial engineering. And a lot of this, one of the best at doing this was John Malone in the Liberty companies. A number of the companies in the portfolio started out as Liberty Holdings, including the Atlanta Braves Baseball Club, Formula One, and Live Nation. And so, spinoffs are ways to surface value that may be hidden, embedded in other companies. They also provide new fodder for us, new ideas for us, and we love going back to that well, and we think there'll be a lot more of them going forward.
Okay. Shifting gears to GOLS itself, how should we think about GOLS in a broader portfolio? And then what investor base did you have in mind when you came up with this idea?
Yeah, so I'll start with the second part of that question. You look at what the ultra wealthy have done with their money. They bought a lot of sports franchises because it was really only accessible to the ultra wealthy, and there are reasons that they did that. One, and this is probably less appreciated, these sports franchises are actually really good businesses. You're talking about companies or businesses with pricing power, with recurring revenue. These are often, very long dated sports contracts, subscription ticket revenue, and very little capital intensity. Every so often you build or refurbish a stadium, and that's generally paid for by somebody else. But let's face it, a lot of the value in these franchises is related to ego. It's related to wealthy people wanting to buy a piece of or all of a franchise that they grew up rooting for. And so that's always going to provide a base, some underpinning for where franchises trade. We wanted to make sports ownership accessible to the everyday retail investor. And we're doing that also with the benefit of allowing access to foreign listed franchises.
Okay.
It's very difficult for U.S. investors to own foreign ordinaries. It's either expensive or they just can't do it because their brokerage doesn't allow them to do that. This does, and we do so on a very cost-effective basis. There's no fee in the first year of this fund, and again, we allow full liquidity as opposed to some of the limited partnerships out there, which charge 2 and 20 and have much more limited liquidity.
Okay. Okay, great. And so why now for the ETF? Why is it a good time?
Yeah, again, as I mentioned, we think reached critical mass in terms of the opportunities that were out there. Maybe 10 years ago, there weren't enough publicly traded members of this ecosystem to provide proper diversification to offer investors. And now is the time. I think also, reached a point in the market where there's a lot of volatility. There's the threat of AI, et cetera. I think in many ways, this is an anti-AI play. You think about trying to find something, an investment that's probably at least immediately not going to be impacted by AI. And I think AI is going to be a generational impact. It's going to touch everything, but at least for the short term, probably not going to replace the team on the field. I would also say, to your earlier question as to where this fits, you think about the spectrum of assets that you can buy. Maybe put gold on one side, not GOLS, but gold, the physical metal, which has some industrial uses, but it's mostly just there to sit there, doesn't provide any cash flows. But it has been a store of value, a means of transaction for literally thousands of years. And on the other side, you've got maybe an industrial company that produces lots of cash flow. You don't know really what it does. Sports teams are somewhere in the middle. They're probably closer to gold. They're less correlated to what happens in the overall economy. So I think for a lot of investors, this is a diversifier. It's something different. It's a great store of value. And again, that's part of the reason wealthy people own it. And we think it belongs in everybody's portfolio.
Thank you, Chris. And just with that, I want to pause for a moment and just invite our audience to submit some questions utilizing the Q&A function at the bottom of your screen. So if we're unable to answer your question live today, a member of our team will follow up with you. As we wait for some questions to come in, I just want to continue here and ask you to talk a little bit about some of the portfolio holdings within GOLS and the investment thesis behind them.
Sure. So we love talking about stocks. Again, we are very much bottom-up stock pickers here. I'm an old Yankees fan. If you remember the dynasty days in the 90s, they talk about the core four. I have my core four. It's the Atlanta Braves Baseball Club, Madison Square Garden Sports, which owns the Knicks and the Rangers, Formula One, which is actually the league that runs that racing promotion, as well as the Manchester United Football Club, known to us as soccer, but public listed here in the U.S. These are all relatively liquid, relatively large holdings. They are, in fact, four of the top holdings in GOLS. So just talking a little bit more specifically about one that we followed for a long time, the Atlanta Braves Baseball Club, as you mentioned, or I mentioned earlier, was a spinoff. Was at first a tracker stock that came out of Liberty Media, and then was spun off as an asset-backed stock a couple of years ago. They're about 62 million shares. Stock's around $40. They've got about 700 million of debt. So there's really two assets in that company, the Braves, and then the surrounding multi-use real estate, which is a fabulous place to watch a game. If you're ever in Atlanta, have time, I suggest you go there. That's probably worth at least $1 billion. So if you take that out of the enterprise value, you're creating the Braves Baseball Club for something like $2 billion. We think the Braves are worth well over $3 billion, probably closer to $4 billion, based on where other baseball franchises have traded. Baseball franchises generally trade on a multiple of revenue of something like 5 to 6 times. And again, I think those multiples probably will go higher as we get through a few events that we may talk about. But again, great business that we think you're buying at a big discount.
And maybe you can share a little bit more on Madison Square Garden Sport and
sure.
the Knicks and the Rangers.
That was also a spinoff, actually. That came out of Cablevision in 2010. Had a few other businesses that were spun from that. But MSGS is the symbol. 24 million shares. The stock is around $280, about 200 million of debt. They've got some hidden assets. So that enterprise value is about $7 billion. For that, you get the New York Knicks and the New York Rangers. I mentioned earlier that the Lakers sold for the equivalent of $10 billion last year. If the Lakers are worth 10, the Knicks are worth more than that, and then you get the Rangers for more than free. The Rangers, one of the original 6, are probably worth 4 or 5 billion. So you're basically getting those franchises for half off, or at least half off. Now, the reality is that the Dolan family, who controls Madison Square Garden Sports, is probably not going to sell control of those teams, because why would they? But there are some options for them to surface value. They could sell a piece of a holding company that owns the shares. They could sell minority stakes in the teams themselves. They'd pay out a big dividend. They could also go private. So all of those we think would either surface value or allow investors to cash in on what is a very large discount to their private market value.
Well, thanks for answering that. I'm sure you saw across the screen a question had just come in about the likelihood of a sale for the Knicks.
Yeah.
So another question here, the size of the investable universe. You mentioned a finite number of teams. How do you feel about diversification within the fund?
By the way, you should have asked me about the likelihood of the Knicks being NBA champions. I wouldn't be able to give you a good answer on that one either, but certainly they are pretty well positioned, the best they've positioned in a number of years. I'm not sure how much that impacts private market value, but that's another story. In terms of the investable universe here, one of the attractions of sports is that there is a finite number of teams. You're talking about 32 football and hockey clubs, 30 baseball and basketball teams, which makes them scarce and worth more. There are going to be more teams, we think, coming public. One I'll mention, again, going back to stock specifics, one that we're pretty excited about and actually own is Rogers Communication, better known as the converged cable and wireless operator in Canada. But almost, depending on how you count, half the value of that company comes from their ownership of the Toronto Blue Jays, the Raptors, and the Maple Leafs, as well as the soccer club in Toronto. They have actually publicly stated that they intend at some point, probably this year, to surface value by either IPOing or spinning off that entity separately. And so that will add to the list of, again, we own Rogers today in anticipation of that happening, but that will be probably a separate sports entity, a really interesting one that we'll own more of. I think you're also going to see some uplistings of European football, what we would call soccer clubs here in the U.S. If you've been to any of these soccer stadiums in Europe, let's call them very traditional, and a lot of those clubs need capital to upgrade their buildings. Obviously, the U.S. is a very deep market, and it makes sense for them to list here, as Manchester United did. I think one of the other things we haven't mentioned is that, of course, the World Cup is here this year in North America, including a number of games, including the final just across the river in New Jersey. And I think that will spur interest in soccer here in this country. Obviously, very big market. Those in the World Cup, we talk about the Super Bowl reaching 125 million people. The World Cup finals reach 1.5 billion people around the world. So, we think there's a big opportunity for the U.S. and think that a number of teams will tap that interest.
Thank you, Chris. So we've talked a little bit about soccer, baseball, basketball, hockey. Another question here from the audience is, does GOLS have any exposure to golf?
So indirectly, we don't have exposure, for example, to Live Golf. Who knows what happens with that? But we do own, for example, Versant, which is a recent spinoff from Comcast. They are best known probably as the owner of CNBC and MS Now, but they do own the Golf Channel, which has rights to a number of golf championships, and very cheap stock. Some questions about what happens with them. They've got actually a pretty good balance sheet. Frankly, I think that somebody could buy the Golf Channel just as a trophy asset all by itself. Obviously, all the big broadcast networks, which we own to some extent, have exposure to golf, and so it's obviously the viewers of golf tend to be highly valued because they tend to be a bit wealthier, but not the driver, admittedly, that say football is.
Thank you. Can you talk a little bit more about cord cutting and cable and how that impacts the landscape?
Yeah, good question. Obviously, cord cutting has changed the ecosystem pretty dramatically over the last 10 or 15 years. Interestingly, we actually did see Charter Communications report an increase in their video subscribers last year, which is the first time any cable company or any publicly traded cable company has done that since COVID. So there is an evolution going on. There is going to be a great rebundling of content. I think that benefits the linear cable ecosystem. I'm not going to say we reached the bottom, but it does become actually more economic for consumers to pay for content that way. But again, in this evolution, we have moved beyond it. And you have obviously subscribers to Netflix far surpassing the old linear subscribers, and they're the ones who are buying these sports rights and paying big prices for them. So really, that is the future. There were more questions, I would say, a couple of years ago. It's pretty clear now that that's going to happen to those media rights.
Shifting back to baseball for a moment, how might a lockout, how likely is it? And could we see a type of salary cap?
Yeah, so sadly, as a baseball fan, I think it's highly likely that we'll see some work stoppage. Who knows? Maybe not. But this current collective bargaining agreement goes through the end of the upcoming season, 2026. The owners, for a very long time, have wanted a salary cap, which exists in varying forms in all the other big four leagues. The baseball players probably want a salary floor to make sure that even the players at the bottom of the majors get paid a minimum amount. So there's probably some trade-off to be had there. Again, that's one of those elements, along with a reset in the baseball media rights, which will occur on January 1st, 2029, or probably before, that will ultimately increase the value of baseball teams. Right now, baseball teams on average trade at a discount to hockey teams,
Okay.
which really doesn't make any sense to me. And they trade at, roughly half where basketball and football teams trade, which it also is too great a gap. So I think that's actually, we'll have some short-term pain, but beyond that, I think it's a big opportunity for owners of the baseball teams to make a lot more money.
Thank you. Another one here. So the ETF provides access to this landscape for more of the retail investor. Are we seeing any institutional adoption?
Yeah, absolutely. One of the things that's actually surprised me is the number of calls that I've gotten from institutional buyers, and including family offices. I mean, most family offices of all sizes are looking at sports for the reasons that we've talked about. Is this is a separate, many of them who think this is a separate asset class, and unless you've got a lot of money and can buy a franchise yourself, it's difficult to participate, especially if you don't want to have your money locked up and pay 220. Right. So again, very convenient way to get your foot in the door and participate in a diversified way in the sports dynamics.
Thank you, Chris. So with that, I would like to thank you for your time. Absolutely. Thank everyone online for joining in today. Just to recap some of the conversation, what a great overview on the sports investing universe, the key drivers, where the cash flows come from, and how you employ the Gabelli private market value with a catalyst investment approach. I think when we think of sports, we think of the teams themselves and the players. And in reality, it's a much more complex, diverse network. And it's fantastic that GOLS can provide access to the entire landscape in a single vehicle that's actively managed and research driven. So with that, if anyone online has additional questions or would like more information, please reach out to your Gabelli representative. Additionally, we can be reached at etf@gabelli.com or on our website, gabelli.com, for more information and important disclosures. Thank you so much. Take care.
Chris Marangi is the co-CIO for Value and a portfolio manager of the GOLS ETF. Katie Durkin is a senior vice president at GAMCO Asset Management. GAMCO is providing these links as a matter of general information. We do not intend for these links to be a complete description of any security or company, nor is it a research report with respect to any of the companies mentioned herein. This webcast was recorded on February 11th, 2026. As of February 18th, 2026, the top 10 holdings of the GOLS ETF are 1. Atlanta Braves Holdings Inc. C. 6.60%. 2. Madison Square Garden Sports 6.43%. 3. Liberty Media Corp. Formula A 6.29%. 4. Rogers Communications Inc. B 5.16%. 5. Liberty Live Holdings A 5.14%. 6. Manchester United PLC CLA 5.13%. 7. Madison Square Garden Entertainment 4.60%. 8. TKO Group Holdings Inc. 4.42%. 9. The Walt Disney Co. 4.16%. 10. Cannae Holdings Inc. 3.21%. Shares of this ETF are bought and sold at market price, not NAV, and are not individually redeemed from the fund. Buying or selling ETF shares may require additional fees, such as brokerage commissions, which will reduce returns. These additional risks may be even greater in bad or uncertain market conditions. Funds investing in a single sector may be subject to more volatility than funds that invest more broadly. You should consider the ETF's investment objectives, risks, charges, and expenses carefully before you invest. The ETF's prospectus is available from G. Distributors LLC, a registered broker-dealer and FINRA member firm, and contains this and other information about the ETFs and should be read carefully before investing. To obtain a prospectus, please call 800-GABELLI or visit gabelli.com/ETFs. Distributed by G. Distributors, LLC, a registered broker-dealer and FINRA member firm. 1 Corporate Center, Rye, New York, 10580,